8 ways to know that you're living in a stock market bubble. Even though it might not appear that way, absolutely no one is immune to stock market bubbles. Those who seem to be protected only appear that way because they take precautionary measures. With these precautionary measures, identification is the first important step. In this video, we discuss 8 ways to know if you're living in a stock market bubble. 8. Expert input is suppressed. One of the first worrying signs of a stock market bubble is that expert input is suppressed. These individuals, who would be valued in any other market environment, are made to seem like their advice is archaic. As such, their voices and input are suppressed, leaving the gullible masses confused. Only after the market crashes is the wisdom of these individuals revealed. No one is perfect, sure, but by paying attention to the experts, you stand a better chance of making the right decision than you do by following greedy novices. 7. Assets go up in a straight line. Another telltale sign of a stock market bubble is that the prices of assets go up in a straight line. This is in contrast to the zigzag shape that is usually typical of stock market indexes. Prices going up in a straight line means people are buying without selling. Assets that are valuable and legitimate typically don't elicit this kind of behavior. When you read such trends, then you need to keep your eyes out for other signs of a stock market bubble. By itself, it may not be enough, but by detecting other signs of a stock market collapse, you would be getting somewhere. 6. A good narrative develops. Never underestimate the power of a good narrative. Narrative doesn't just belong in works of fiction. It invades real life more often than not. Politicians are some of the best users of narrative. They create stories to bend people to their will. Unfortunately, the financial world has its fair share of narrative abusers. These are people who, unconcerned with facts, create stories about whatever asset they need to sell. And so when you notice that there's very little analysis and very much narrative around a particular asset or set of assets, then you need to keep your guard up. 5. Conditions are unsustainable. Inasmuch as a lot of people make deals with debt and liquid assets, each of these investments is grounded. If you go looking for the money, you will find it. This is the case in the stock market 90% of the time. The other 10% of the time, if the paper trail doesn't quite add up, it may imply that there's a market bubble or an impending stock market crash. In such situations, the fallbacks which money lenders and risk takers rely on to generate them extra capital simply do not exist. The conditions are unsustainable, so to speak, and all ventures, which would have financed themselves in times of market stability, simply do not have the same ability to do so. And so, if you see that some interest rates are too good to be true or that some dividends are arriving at unusual times, then this could be a sign of such a development. At times such as these, share prices may be reflecting unsustainable growth rates as well. This is just another way to say that things may be overvalued. 4. Influx of new buyers. An influx of new buyers is a great thing in most markets. However, in the stock market, it can be a very telling warning sign. Since the prices of most assets are determined by supply and demand, new buyers could cause demand to outpace supply. When this happens, the value of most assets becomes inflated beyond what it should be. The question also remains as to where these new buyers are coming from. In a healthy market, there should be organic growth of traders over time. If a large number of new traders seem to appear out of nowhere, it should be cause for caution. 3. Prices are higher than they should be. As much as the stock market is unpredictable, traders and analysts have certain parameters they rely on to help them make their forecasts. These include price-to-earnings ratio, return on investment, earnings per share, return on equity, and compound annual growth rate. Whenever these parameters are presenting a wider margin of error than what is actually observed in the market, it could be a sign that things are amiss in the market. Reading the stock market is more of an art than a science, but that doesn't mean these parameters cannot be trusted. Their usefulness is especially evident when an analysis of previous market crashes is done. In the 2008 financial crisis, all these parameters were skewed at the time. The bigger the bubble, the more skewed they are. 2. Big bullish sentiment. Bullish sentiment isn't necessarily a bad thing. However, at its extremes, it refers to how valuations on assets are made with feelings and emotions rather than facts and figures. People's enthusiasm about an asset morphs into overconfidence. This overconfidence then carries over to other traders, who are made to feel silly about their skepticism over the asset in question. The effect of this warped bullish sentiment is that there is ridiculous fear of missing out, causing others to cash in and drive up the value of the asset. This creates a cascading effect that pushes the borders of the bubble far and wide. 1. People borrow to buy. One of the big signs of a market bubble is when people place themselves in debt to get in on a particular asset. This isn't to say borrowing is inherently bad, as the best traders leverage debt to build wealth. The difference here is that people place themselves in debt when every major stock market parameter is wonky, which means that they might have to pay more for their debt than they initially assumed. People in this kind of situation usually bank on others wanting to pay more for the asset than they did themselves. However, more people falling for this implies that the floor will eventually cave in on this scheme, bringing everything crashing down. And being in debt in the aftermath of a market crash is such a horrible position to find yourself in. Financial institutions are less forgiving, as they themselves may need funds to recoup their losses. Coming to the end of this video, we hope you've learned a couple of key strategies for identifying stock market bubbles. Learning and applying these skills is one of the best skills that any financier could hope to have. In any case, to learn more, check out other videos on our channel. Until next time, have a great day.